You thought the AI bubble was bad? The cloud computing industry just realized they built a $300 billion empire on quicksand. And when this falls, it's taking your Netflix subscription, your company's entire infrastructure, and possibly the internet itself with it. Here's the financial time bomb nobody's talking about. Right now, 3 companies control nearly 2/3 of the world's cloud infrastructure. Amazon, Microsoft, and Google. They convinced every business on Earth to abandon their own servers and rent digital space instead. Seemed genius, until the math stopped working. These hyperscalers have been hemorrhaging cash-building AI data centers, betting everything on artificial intelligence revenue that hasn't materialized. Meanwhile, their core cloud customers are waking up to a brutal reality. They're trapped in contracts they can't afford, dependent on infrastructure they don't control, with no exit strategy. The warning signs are everywhere if you know where to look. Earnings reports buried in creative accounting. Capacity utilization numbers that don't. Every time you stream a movie, send money through Venmo, or have your medical records pulled up at a hospital, you're pinging one of 3 companies. Amazon Web Services, Microsoft Azure, and Google Cloud don't just dominate the market, they are the market. 65% of every digital interaction on Earth flows through their servers. Netflix, AWS, most major banks, Azure, the startup handling your prescription refills, probably Google Cloud. This isn't some abstract financial story about shareholders losing money. This is about the actual infrastructure holding modern life together. When these platforms hiccup, airlines ground flights. When they go down, emergency services lose communication. When they struggle financially, they don't just cut to jobs, they cut capacity. And right now, all 3 are hemorrhaging cash trying to win an AI arms race. Nobody asked them to fight. They've bet hundreds of billions that artificial intelligence will justify every dollar spent. The question nobody in Silicon Valley wants to answer is deceptively simple. How did the most sophisticated financial minds on the planet construct a business model built on the same circular financing schemes that destroyed Enron and triggered the 2008 global meltdown? The answer lives in 3 words that should terrify every investor holding cloud computing stock: compute credit deals. Here's what the earnings calls won't tell you. When a major cloud provider reports billions in new AI revenue, a significant portion isn't coming from customers paying cash. It's coming from startups spending credits that the cloud provider itself funded through venture investments. The money goes out one door as an investment, walks around the block, and comes back in the other door disguised as revenue. Enron called these prepay transactions. Banks in 2007 called them structured investment vehicles. Today they're called strategic cloud partnerships. Different decade, different industry, identical accounting sleight of hand. The documents tell a story that here's the dirty secret Wall Street doesn't want you to understand. These aren't investments. They're accounting tricks dressed up as billion-dollar bets. Amazon hands Anthropic $4 billion. Sounds impressive, right? But here's the catch. Anthropic must spend that exact amount on Amazon's cloud services. The money never really leaves Amazon's ecosystem. It's a round trip disguised as a partnership. Microsoft plays the same game, only bigger. $13 billion into OpenAI, but OpenAI burns through that cash exclusively on Azure servers. Microsoft books it as cloud revenue, then reports record growth to shareholders. Follow the money. It flows in a perfect circle. Investment out, cloud fees back in, revenue reported, stock price climbs, more investment announced. This isn't venture capital. This is vendor financing with extra steps. The cloud giants have trapped themselves in a codependent spiral with companies that have never turned a profit. They're simultaneously the bank, the landlord, and the biggest customer. 23 years ago, Enron executives sat in Houston boardrooms, engineering the most sophisticated financial illusion in corporate history. Their weapon? Special purpose entities. Shell companies designed to hide debt while booking phantom revenue. They'd sell assets to subsidiaries they secretly controlled, then record the sales as profit. The money moved in circles, but the balance sheet looked immaculate. Arthur Andersen signed off on everything. Technically legal, they said, innovative accounting. We know how that ended. Now look at today's cloud AI deals. Company A invests $2 billion in a startup. That startup commits to spending $2 billion on Company A's cloud services. Revenue appears, stock prices climb, everyone celebrates. The structure is nearly identical. Money cycling through related parties, future commitments booked as present-day wins. Auditors calling it compliant. Enron's collapse erased $74 billion in shareholder value. Here's the thing Wall Street doesn't want you to understand. When Amazon Web Services hands a startup $100 million in compute credits, they're not being generous. They're running the most sophisticated revenue scheme in corporate history. Watch how the money flows. AWS issues credits to a promising AI company. That startup immediately hums those credits on Amazon servers. And here's where the magic happens. AWS records that spending as genuine revenue in their quarterly earnings. But wait, where did the actual cash come from? It came from venture capitalists who funded the startup, the same venture capitalists who invested because they saw AWS backing the company with credits. It's a closed loop. Investment dollars get laundered through compute credits and emerge as revenue growth. Amazon's own promotional documentation reveals the structure. Credits expire. They're non-transferable. They exist purely within Amazon's ecosystem. This isn't commerce, it's accounting alchemy. Here's what Amazon doesn't want you to understand about their Anthropic deal. In September 2023, Amazon invested $4 billion into Anthropic. That's real cash leaving Amazon's treasury. But here's where it gets interesting. As part of that investment, Anthropic committed to spending $4 billion on Amazon Web Services infrastructure over the coming years. Follow the money. Amazon writes a $4 billion check to Anthropic. Anthropic turns around and writes that same money back to Amazon's cloud division. AWS then reports this as revenue growth. Wall Street celebrates. Stock price climbs. But wait, those are the same dollars. Amazon essentially paid itself and called it growth. The cash made a round trip out of Amazon's corporate treasury into Anthropic's bank account straight back into AWS's cloud spending. One pile of money counted twice on the balance sheet. Once as a strategic investment, once as organic cloud revenue. This isn't illegal. Here's the time bomb Wall Street doesn't want you to see. When a cloud provider builds a $50 billion data center, they don't record that as an immediate expense. They spread it out. Depreciate it over 10 years. That means their books show just $5 billion in annual costs. Nice, clean, predictable. But here's the problem. GPU technology doesn't last 10 years. It becomes obsolete in 18 to 24 months. That shiny new AI chip you just paid a premium for, it's already being replaced by something twice as powerful. So what happens to that $50 billion facility when the hardware inside it is worthless in 2 years? The math is brutal. If you have only depreciated $10 billion over 2 years, but you need to replace everything now, you're sitting on $40 billion in assets that are suddenly worth a fraction of their book value. That's not a write-down. That's a detonation. And this isn't one company's problem. Every major cloud provider is running the same playbook, the same aggressive depreciation schedules. Here's the terrifying math Wall Street doesn't want you to see. Buried in financial footnotes, not press releases, are binding purchase commitments that could bankrupt the cloud industry. Microsoft has committed to $44 billion in future chip purchases. Amazon's obligations exceed $50 billion. Google, another $38 billion. These aren't projections. These are legally binding contracts, primarily with one company, NVIDIA. The hyperscalers made these commitments when AI demand seemed infinite. They locked in price. They guaranteed volumes. They signed multi-year agreements that cannot be cancelled without catastrophic penalties. Now consider what happens if enterprise AI adoption slows by even 20%. These companies must still purchase chips they cannot deploy profitably. They've essentially bet their entire capital expenditure strategy on AI demand not just continuing but accelerating indefinitely. The year was 2008, and Wall Street had performed the greatest magic trick in financial history. They took worthless mortgages, sliced them into tranches, scattered them across the global economy, and convinced everyone the risk had simply vanished. It hadn't vanished. It had metastasized. Today, Silicon Valley has perfected the same illusion with different instruments. Follow the money. Microsoft invests $13 billion in OpenAI. OpenAI spends billions on Microsoft Azure. Amazon backs Anthropic. Anthropic pays Amazon Web Services. Google funds AI startups who rent Google Cloud infrastructure. It's a carousel of capital where everyone owes everyone, and nobody can trace where the actual value creation occurs. The cloud providers count AI spending as revenue. The AI companies count cloud investments as validation. The venture capitalists count both as proof the party never ends. But here's what the 2008 crisis taught us. Circular dependencies don't create stability. Now let's untangle the most Byzantine financial arrangement in tech history. Microsoft invested $13 billion into OpenAI. In return, OpenAI runs exclusively on Azure, Microsoft's cloud platform. Here's where it gets interesting. When OpenAI pays Microsoft for cloud computing, Microsoft books that as revenue. They're essentially paying themselves with their own investment money and calling it growth. But wait, there's more. Microsoft also receives 75% of OpenAI's profits until that $13 billion is fully repaid. The problem? OpenAI has never turned a profit. They're burning through capital faster than they can raise it. Yet somehow OpenAI carries a $150 billion valuation. A company with negative cash flow, completely dependent on a single customer who is also its primary investor and infrastructure provider. The circular logic is staggering. Microsoft's AI revenue depends on OpenAI's success. Here's the math that should terrify every investor in this space. AI startups backed by hyperscalers are collectively burning through $20 billion annually, just on compute costs alone. Not salaries, not marketing, just keeping the servers running. And here's what nobody wants to talk about. Most of these companies have absolutely no realistic path to profitability. None. They're buying time, not building businesses. The average AI startup right now has 18 to 24 months of runway remaining. Look at that number again, 18 to 24 months. Now remember what we said about GPU obsolescence cycles? They're identical. This isn't coincidence, it's synchronized detonation timing. These companies will need to replace their entire compute infrastructure at the exact moment their funding runs dry. They'll approach investors for more capital, while simultaneously admitting their core technology is already outdated. The burn rate charts tell the story plainly. Cash reserves declining at 40, 50, 60%. The accounting magic happens in plain sight. When a cloud provider extends $100 million in credits to a startup, that startup immediately spends those credits on cloud services. Under generally accepted accounting principles, this books as legitimate revenue the moment the service is delivered. The auditors sign off because, technically, two separate legal entities engaged in an arm's-length transaction. But follow the money. It starts in the cloud provider's treasury, moves briefly through the startup's account, then flows right back as payment for services. The provider's revenue line swells, their cash position barely changes. Wall Street celebrates the growth. This isn't fraud, that's what makes it so dangerous. Every transaction meets the letter of accounting law. Revenue recognition rules require only that a service was provided and a customer agreed to pay. They don't ask whether that customer's ability to pay originated from the vendor itself. It's a closed loop disguised as commerce. The provider is essentially paying itself. Google isn't just playing catch-up, they're gambling everything. As the third-place hyperscaler, Google Cloud has been hemorrhaging cash to win AI customers. Their strategy? Outspend everyone. Longer contract terms, more generous credits, sweeter deals than AWS or Azure would ever offer. And it's working, on paper. Google Cloud's AI revenue has exploded, growing faster than either competitor. Wall Street celebrated. Analysts upgraded the stock. But here's what they're not telling you. Google's parent company Alphabet has invested billions in Anthropic, the same AI startup that Amazon is also backing. Think about that. Google is funding a company that competes with its own AI offerings while simultaneously giving that company's rivals free cloud credits. The circular exposure is staggering. When you strip away the promotional credits, when you account for the deferred revenue, when you examine the actual cash changing hands, Google Cloud's AI growth looks increasingly. Here's how it starts. One name, one headline, one domino, a major AI company, let's call it $1 billion unicorn, misses projections badly, burns through its runway, announces it's cutting 70% of its cloud compute. The provider holding $300 million in credits takes the write-off. Stock drops 8% overnight. Now Wall Street wakes up. Analysts start asking questions. How many other arrangements look like this? How much phantom revenue is hiding in quarterly reports? Credit terms tighten within weeks. Suddenly, AI startups that relied on deferred payments face invoices they can't cover. 10 companies fold, 20. Each one triggers another write-off. Cloud revenue growth, the metric that justified everything, goes negative for the first time in a decade. Data centers that cost billion dollars to build now sit at 60% utilization. Accountants are forced to impair assets worth tens of billions. The battlefield is already soaked in blood. AWS just slashed enterprise storage prices 17%. Microsoft countered with 22% cuts on compute instances. Google's offering migration credits worth millions to poach clients. This isn't competition, this is desperation wearing a strategic mask. When AI workloads evaporate, three giants will suddenly find themselves hunting the same shrinking pool of traditional enterprise customers. But here's the catastrophic math they're ignoring. These companies carry combined depreciation expenses exceeding $90 billion annually. Those server farms don't stop costing money just because demand disappeared. Every price cut to win market share accelerates the timeline to write-downs. Wall Street models show gross margins compressing from 62% to 41% within 18 months of sustained price warfare. At 41% margins, current infrastructure investments become permanently unprofitable. The death spiral locks in. Here's the math. Wall Street doesn't want you to see. Combined, the cloud divisions of Amazon, Microsoft, and Google carry implied valuations north of $300 billion. That number assumes they're high-growth tech companies riding the AI wave to infinity. But what happens when the market realizes they're actually utilities? Electric companies trade at 12 to 15 times earnings. Telecom providers, maybe 10 to 14. These are mature infrastructure businesses with stable but slow growth. Cloud computing is becoming exactly that. Apply utility multiples to these cloud divisions, and you get a very different picture. AWS, currently valued around $100 billion, cut that in half. Azure's premium valuation, slash it by 60%. Google Cloud, similar story. We're not talking about a correction, we're talking about a fundamental re-rating of what these businesses are actually worth. The total damage, somewhere between 150 and the numbers don't lie, but they do hide in footnotes. Here's what Wall Street isn't telling you. Start with AI, customer revenue as a percentage of total cloud revenue. AWS sits at 31%. Azure hits 38%. Google Cloud reaches a staggering 44%. These aren't customers, they are dependents. Now look at disclosed compute credit liabilities. Microsoft has extended over $12 billion in credits to AI startups. Google has committed $9 billion. Amazon trails at $7 billion. These are IOUs that may never convert to cash. The purchase commitment footnotes reveal even more. All three have locked in GPU orders through 2028, totaling over $90 billion combined. They're betting everything on demand that might evaporate. But the real scandal, depreciation assumptions. They're writing off AI servers over 6 years while the technology refreshes every 18 months. That's aggressive accounting masking. The collapse won't stay contained in Silicon Valley boardrooms. When hyperscaler stocks crater, the automated systems kick in. Index funds rebalance. ETFs sell. Your retirement account, sitting quietly in a target date fund, suddenly hemorrhages value because some algorithm decided Microsoft deserves a lower weighting. The S&P 500 is now 28% technology. One sector's correction becomes everyone's problems. But the real damage runs deeper than portfolios. Remember that invisible infrastructure running civilization? Hospitals managing patient records, banks processing transactions, governments coordinating emergency services. Every enterprise customer now faces a nightmare scenario. Their cloud provider is distracted, cutting costs, laying off the engineers who keep critical systems running. Startups built entirely on AWS discover their foundation is shaking. Payment processors, logistics platforms, the apps coordinating modern life. They called themselves infrastructure. As essential as electricity, as permanent as concrete. But you've seen the truth now, $300 billion built on circular revenue where companies pay each other to inflate growth numbers. Built on hardware they've already depreciated to zero. Still humming in facilities that cost millions to cool. Built on AI promises that require 10 times the computing power they currently possess. The cloud titans didn't build a foundation. They built a performance. And performances end. The hyperscalers will survive in some form. They always do. But the stocks trading at 30 times revenue, the pension funds betting retirement money on infinite growth, the businesses that moved everything to platforms they don't control, they're standing on quicksand. And it's already shifting. You've seen the depreciation tricks, the pricing traps, the efficiency myth, the AI spending that doesn't add up. The question was never whether this empire would crack. The question is whether you recognize the tremors in time.